All right, so it's midweek, and the silver market just did something that made every experienced trader I know stop what they were doing and stare at their screens. Silver, yeah, that quiet, precious metal your grandparents used to give as wedding gifts, just ripped almost 9% higher in a single trading day. And this isn't happening in a vacuum. This comes right after one of the ugliest, fastest collapses we've seen since the 1980s. We're talking about a move from $90 down to 70, then snapping back toward the mid-eighties. That's not normal price action. That's a whip crack. And if you're holding silver right now, or if you've been watching this market wondering when to jump in, or if you're just trying to understand what the hell's going on, stay with me. Because what happened Tuesday and what's coming Wednesday could decide which side survives. The panic sellers who bailed too late, or the brave souls who've been catching falling knives with bare hands. Now, before I unpack why silver just turned into a roller coaster that'd make Six Flags jealous, let me teach you one simple principle that'll change how you watch any market. Markets don't move because people suddenly change their minds. They move because money changes sides. Most people think when a market drops, it's because bears suddenly appear out of the woods with bad news. Not really. Think of it like a crowded elevator. When everyone's already inside, even good news doesn't make it go higher. It just overloads the cables. In parabolic phases like silver's January climb, everyone gets jammed in at once. Traders, institutions, retail investors, momentum funds, everybody piles in. Then when price slips even slightly, the door reverses, and everybody tries to squeeze out at the same time. The physics of that, what we call liquidity compression, creates those whiplash candles you could literally surf. And if this is making sense so far, drop a comment below and tell me what you're watching in silver right now, because I want to know where you're at in this trade. So here's what's actually happening underneath those price bars. Last week, silver's explosion to $122 pulled in a tidal wave of leveraged traders. Futures contracts, options buyers, even momentum ETFs chasing the move higher. When price broke below $100, margin calls began. That's when brokers tell you, hey, you need to add more cash or we're closing your position. And that forced liquidation meant accounts dumped contracts regardless of fundamentals. They weren't selling because they suddenly hated silver. They were selling because they had to. The cascade pushed the metal to the low 70s in just 4 days, slicing more than 40% of its paper value. That looked catastrophic if you were watching it tick by tick. But here's the twist that most people miss. Forced selling doesn't necessarily mean true bearish conviction. It's mechanical. It's systematic. So when that pressure finally exhausts itself, when the last forced seller has been squeezed out, prices rebound violently. Not because the world suddenly loves silver again, but because the forced sellers ran out of bullets. Tuesday's 9% pop is that pressure relief. It's the elastic snapback after an overstretch. Think of it like pulling a rubber band as far as it'll go. When you let go, it doesn't drift back slowly, it snaps. Now here's the part that should make you nervous. Those late rally buyers from January, the ones who bought silver at 110, 115, maybe even 120, they're still trapped. They're sitting on positions with triple-digit cost bases, watching their accounts bleed. If Wednesday's market drifts back towards $75 or $80, many of them will face a second margin squeeze. And that's why professionals call these zones volatility pockets. You've got buyers stepping in because they see value. You've got shorts covering because they're scared of another rip higher. You've got algorithms hunting stop-loss orders. Everyone's trading the same heat map, the same technical levels. So until positioning cleans up, until we know who's still underwater and who's gotten out, you're not seeing trend. You're seeing mechanical equilibrium fights. It's like a tug of war over a cliff edge, and nobody wants to let go first. But let me show you something. This episode isn't some alien event that's never happened before. Zoom out and it fits an old rhythm. Every time silver's made front page news, you see the same anatomy. In 1980, you had the Hunt brothers trying to corner the silver market. Price went parabolic, then collapsed vertically. In 2011, during the QE fever rally, silver hit nearly $50, then got cut in half in weeks. Even in 2020, during the pandemic rip, same pattern. In each case, parabolic rises ended with vertical collapses, then weeks of churning between roughly halfway points of the move. In 2011, that mid-zone ran from about 60 down to 48. In 2020, it was 32 down to 22. Now it's roughly 75 to 90. Pattern recognition isn't bravado. It's basic probability. After vertical volatility, silver almost never stabilizes quietly. It thrashes, it chops, it tests both sides. That's why today matters. Not because headlines are screaming record rebound or silver's back. It matters because we're at the inflection zone where emotional traders get tested and patient ones quietly build positions while everyone else is distracted by the noise. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this rebound actually mark the bottom? Yeah, maybe. Some analysts argue industrial demand's improving. Electric vehicles need silver. Solar panels need silver. Others say inflation hedge flows are reviving as people lose faith in paper currencies. Those are fair points. Then you've got the other camp shouting manipulation. Big banks smashing the price on purpose to cover short positions. I've heard these theories for decades. Here's the thing. It doesn't actually matter whether there's manipulation or not for your trading decisions. Markets exaggerate all extremes, both the exuberant highs and the despairing lows. You can't control that. What you can control is recognizing when movement is forced versus fundamental. Trade the reaction, not the narrative. That's where discipline beats drama every single time. There are probably 3 types of people watching this right now. First, you've got the adrenaline chasers. Your heart's racing, charts are open, fingers twitching on the buy button. You see that plus 9% candle and you're thinking, reversal. This is it. We're going back to 100. Slow down. Volatility is attraction, disguised as opportunity. It looks like a trade setup, but it's really a trap unless you wait for structure. Wait for a higher low, not just a bounce. Wait for confirmation that buyers are actually showing up with real conviction, not just short covering panic. Second, you've got the long-term stackers. You own physical silver, maybe you've held it for years. You don't watch ticks, you watch decades. For you, moves like this are just noise. But still, understand the mechanics. Knowing how paper markets thrash around helps you buy when others are panicking. It helps you add to your stack when silver's on sale, not when everyone's euphoric. And third, you've got the curious learners. You're here to understand how professionals read chaos. You want to know what signals matter and what's just spectacle. The big takeaway for you is this. Volatility isn't random punishment. It's the market's way of redistributing risk from weak hands to strong hands. Respect it, don't fear it. And across all 3 groups, remember the universal rule. Liquidity creates illusion. Supply and demand settle the truth only after the shouting stops. So here's what I want you to answer in the comments. Which type are you? Are you actively trading this? Are you stacking physical? Or are you just learning how to read these moves? Because your answer changes what you should be watching next. Here's where I stand. I'm not a silver bull or a silver bear. I'm a volatility realist. I'm watching 3 things closely, and I'm going to tell you exactly what they are. First, I'm watching price behavior around $75. That's the level where we'll learn if Tuesday's surge had real substance or if it was just short covering breath. If silver holds above 75 and starts building higher lows, that tells me buyers are gaining conviction. If it slices back through and trades in the 60s again, that tells me the forced selling might not be done. Second, I'm watching open interest in the futures market. Open interest is the total number of outstanding contracts. If it keeps shrinking, that means the fire's dying down. Participants are leaving, the volatility's fading. If it rebuilds fast, that means new players are entering, and this tug of war continues. And third, I'm monitoring the US dollar's pulse. Because a rising dollar can choke even the bravest metal rallies. When the dollar strengthens, commodities priced in dollars usually weaken. It's just math. If the dollar index starts climbing, silver's going to have a harder time sustaining any rally, no matter how enthusiastic the silver bugs are. Tuesday's blast wasn't magic. It wasn't some mysterious force. It was structural, not sentimental. The fundamentals, tight supply, energetic retail interest, global liquidity shifts, industrial demand, those are still there. But sentiment has to reset before any sustainable trend can resume. If history rhymes, and it usually does, we're entering what I call the shaking off phase. This is the phase that clears weak hands, that exhausts the emotional traders, before a steadier climb can happen later in the year. Or maybe we chop sideways for months. I don't know. Nobody does. But I know what to watch to figure it out as it unfolds. Let me give you the honest truth. Based on my analysis, this 9% move was technical and mechanical. It wasn't driven by some new fundamental development. There wasn't a supply shortage announced Tuesday morning. There wasn't some central bank announcing they're buying silver. It was a snapback from oversold conditions and forced short covering. The fundamental picture hasn't changed dramatically in either direction. You've still got strong industrial demand trends. You've still got monetary uncertainty. You've still got supply constraints in certain areas. Those things don't change day to day. What changes is sentiment and positioning. And right now, positioning is a mess. It's tangled. Until it unwinds cleanly, we're going to see more volatility, not less. Now, I'm not a financial advisor. This is not financial advice. You need to do your own research and make your own decisions based on your own risk tolerance and financial situation. But I will tell you this, if you made it this far in this video, you're the type of person who wants to understand the mechanics. not just chase headlines. That mentality will serve you well, whether you're trading silver, gold, stocks, or anything else. Markets reward people who think in probabilities and patterns, not people who react to every price swing with emotion. If you found this breakdown valuable, do me a favor. Share this video with someone who's been asking you about silver. Help them understand what's really going on beneath the surface. And if you haven't already, hit that subscribe button and turn on notifications, because Wednesday's session could bring more fireworks, and I'll be breaking it down in real time. You're watching this right now, which means you're ahead of 90% of people who are just reading headlines and panicking. Stay ahead, stay sharp, and I'll see you in the next one.